Good morning, welcome to the Phoenix Blue Update on Friday the 3rd of March. I'm Tom Colley and I'll talk to you this morning about the markets. Well, a good week for trading. Plenty of opportunities and opportunities playing out. We've seen the resurgence of dollar strength, which is our longer term bias. We still need a little bit more confirmation, which will hopefully come in the form of Janet Yellen speaking later today, which should give us another boost to the US dollar and mean that our plan for the year, which is central bank policy divergence, meaning the US raising rates where everybody else is still easing or even softening rates, will hopefully come into play and give us some really nice opportunities. Okay, before we do anything else, over to the news. Yesterday we had construction PMI coming in spot on forecast on the pound. GDP from Canada, again spot on forecast, and then positive employment claims from the US coming in at 223,000 new unemployment claims against a forecast of 243,000. Going forward to today, and I've got some orange flags, yellow flags, whatever you want to call them here, which are second tier impacts. I'm not so much interested specifically in German retail sales. We've got services PMI out on the pound, which will obviously be very interesting from the pound's perspective. We have non-manufacturing PMI from the States this afternoon. What I'm really most interested in is the FOMC member speeches and the Fed Chairman Yellen speaking this afternoon. So we have Member Evans speaking at 3:15. Evans is perceived as a dove. As I said to you earlier in the week, it's important to have a view of where they're coming from. A hawkish statement from a normally dovish member is more significant, obviously, than a hawkish statement from a hawkish member. 5:15 we have Powell speaking. Powell's listed as another, so it isn't perceived to be particularly hawkish or particularly dovish. Then, of course, the big one, we have the Fed Chair Yellen speaking, and finally we have Fisher speaking, and Fisher is a hawk, so we would expect hawkish comments from him. If we were to hear dovish comments from him, that would then raise our awareness and cause an issue with our thoughts in terms of dollar strength. Okay, over to the markets. Here's the US dollar index. Yesterday we broke above 102, which we see as a very significant level. When this slide was taken this morning, the dollar index had gapped down and opened on 102. Don't get too worried about the dollar index doing that, because it's basically an accumulation of other currencies. When you get the rollover in the evening, it's never very smooth. We don't actually trade this market, obviously, we just use it as a view on dollar strength with awareness of the currencies that it's made up from. So 102, the critical level there. If we can push through there today, it might not happen in the trading day or through on Monday, assuming we get Yellen and the Fed speakers speaking hawkishly. Then we are really into that central policy divergence picture. This week, through a combination of Trump speaking to Congress, where his approach was much more presidential. He was talking about £1 billion worth of infrastructure spending, tax cuts, and 55 billion additional defence spending, and he was making an appeal to Congress to help him get those things through, or that legislation through, to make those things happen with his budget. Those are exactly the sorts of things that Trump was elected to do. They are his policies, and whatever you think of him, he is clearly setting about the process of trying to bring all those policies into effect. But the net result is that was bullish for the dollar. We then had a number of Fed speakers through the week with hawkish statements, and in this week we've gone from the probability, or the futures markets pricing in the probability of 35% for a March rate increase, is now up at around 70 to 75%. So a real change in sentiment there, or a real sentiment being brought forward. That sort of level of expectation was for the May meeting, but now clearly a rate rise on the table for the March meeting, which is the 14th to the 15th of March. We've got a lot of Fed speakers out today, because after today there will be a blackout from the speakers prior to that meeting next week for the meeting the following week. So we won't hear any more from the FOMC members in the intervening period. We saw the same dollar strength playing out on the yen here, through to a level of about 114.40, which is clearly a significant level. What's interesting here is that level is also significant because if we go across to the Nikkei, the Japanese stock exchange, we can see very similarly that it corresponds or correlates very much with this 19,600 level that we've been watching for a long time. If we get a break on to the long side on the US dollar yen, that was yen weakness, we will see a break to the upside on the Nikkei, because as the value of the yen drops, the ability or the profitability of Japanese exports for its businesses increases, so that will in its nature push the Nikkei to the long side. So we will be looking in conjunction with the yen a breakout to the long side on the Nikkei next week, and as always looking for a pullback. We don't trade breakouts, so we will be looking for the breakout to happen and then look to trade the retest of this 19,600 level. The euro naturally was also bearish yesterday. There is a level through here. It's not so much a technical level as a numerical level. It did struggle to beat 105. So for it, 105 is the next key level. Although, as I say, you can see my support level through here is thinner, and that means to me that is a non-technical level. So the level exists, but it doesn't meet all the rules of our technical levels. But again, we will be looking for further downside in this market next week with targets around this 1.35 zone of the previous December lows here. And if the dollar move goes to the long side, we could see this move to the downside towards parity, which has been a big discussion of on the euro for this 2017. So where did we really take advantage of these moves yesterday? Well, the biggie one for us yesterday was the Aussie. Look at that lovely big bar down there. We haven't seen many of those in recent weeks. We got into this trade right at the top here, and we've been sat in it through a period when the Aussie was, to be fair, relative to the dollar, the strongest currency pair, and where other currencies were weakening against the dollar, the Aussie held its ground. It finally capitulated yesterday in a big way, and that move came through there, and at this moment in time that move sits at about 4-to-1 risk to reward. So a lovely trade in there. We're still not at target. We can see target down here at about 7,520. So still more profits to be made, hopefully, before we get to that level. We saw a similar move on Kiwi, although to be fair, we saw that over a 2-day period. We saw Wednesday and Thursday. Unfortunately, this wasn't a market we were still in. We got in at this level here, but was stopped out at break even on this spike back up to our entry here, which left us out of that market. But when you're a trader and you've had a trade like yesterday on the Aussie, it's not the right time to be too negative about what you didn't get. If you'd missed both, then maybe that would be the time to be moaning or bemoaning your bad luck. Another market that we've been talking about, I've been watching, is silver, and we saw silver and gold capitulate yesterday. We were in this market and we were confident, or as confident in the probability as we could be in this market, because we had a COT extreme signal telling us that the commitment of traders, the commercial parties in the commitment of traders report, had reached an extreme level on silver. They hadn't done that on gold, which is why we chose to trade silver on this occasion. We got a nice tight intraday entry through here, and then this market capitulated even faster, and that was basically one move straight down, the majority of it really in a minute or two, and then the last third following through. We're now at a level of about 1785, where our T1 target was. On entering this trade, our trade plan was potentially to see price come down here, pull back to this resistance level at this point for what would potentially be a head and shoulders. It doesn't look like that's going to play out as a head and shoulders now, simply because of the strength of that move there. However, we are still aware of this level. We can see we're still within this very clearly defined channel through here, so we will be looking for a break below there and a pullback into the intersection with the channel next week to take this further to the downside, and potentially longer term targets down 15,500, 15,600 around these levels here. Okay guys, so that's it for this week. It's been a great week, depending how you look at it. That was a great end to February or a great start to March. It's important to to think about where you are in March. We're only 3 days into March, but you quite possibly could have already made your target for the month. Now, natural or human reaction tends to be, oh great, look, I'm up at the beginning of the month, right, this is going to be a huge month, and push on relentlessly. The real way a trader should respond is, right, I've hit my target. My first priority is to retain the profits that I've made. Yes, I will still trade the markets. I might trade them at lower risk. I might restrict the trades that I take to the highest probability trades. I might only take one trade at a time, where on another occasion I might have two positions open at the same time. But the point I'm trying to get across there is if you got to, let's say you got to 5 or 6% at the end of a normal month, you'd be more than happy. To be there in the first few days or the first week of the month, you should be ecstatic, but you should be then cautious, because 2 weeks down the line, you could end up being back where you started or worse, and a bird in the hand is the saying that comes to mind. Right, before we go, just a reminder, Wednesday the 15th of March, that's a week this coming Wednesday, the next free trading event is in London. There will be an icon appearing on the screen in a moment, which will allow you to click through to the website to contact us about that. We also have an event, an all-day event, in Sweden on March the 11th, which is a week tomorrow. It's a Saturday event. Again, if you go through to the website on the link, you can contact us about attending that event. Also, you'll get an icon appearing shortly which will allow you to subscribe to these videos. That means you'll get an email every time one of our videos is uploaded. And also there will be a link that allows you to go and look at historic videos of these videos that we produce every trading day, and we look to have them with you before 9 o'clock in the morning. Okay guys, so hopefully you've benefited from yesterday's events or the week's positive events. Think about what I've said about retaining your winnings or your profits, or what's now your capital, over the weekend, And let's come to the market with a fresh mind on Monday. Have a great weekend, and we'll speak to you then. Goodbye.